Insolvencies in this country have risen to their highest level since the start of the pandemic as rising rates start to take a toll on Canadians. Charles St. Arnaud is the chief economist with the Alberta Central and former economist with the Bank of Canada. Charles, thank you so much for joining us. It's an important conversation to have because while it's not showing up perhaps in aggregate in places like the housing market or perhaps in broad-based consumption, the pain that people are feeling as a result of higher interest rates is starting to show up in areas. What are you tracking?
Well, I've been tracking insolvencies for some time now, especially during the pandemic. There was the kind of unusual big decline in insolvencies because, well, incomes were made up by a lot of the government programs. A lot of households managed to save a lot of money. And now we're seeing all that trend being reversed completely to a point where we have insolvencies now above or almost above where they were in 2019 before the pandemic. But it's also, when we look at the country, there's a lot of provinces where we're seeing insolvencies above 2019. So every province is from Ontario all the way west to British Columbia now have insolvency levels that are above their level of pre-pandemic levels.
Okay, so let's just, for our viewers, what are we talking about when we're talking insolvencies? People not paying their credit card, people not paying their mortgages, making, their car payments. What is in that number?
Well, insolvencies can be put into two baskets. There's what people are kind of used to, like bankruptcy. So you can no longer make your debt, your payment. You need to declare bankruptcy. The bank takes a loss. You have a loss on your credit file. That's kind of one part. But then there's another part, which is called proposal, is that you're at the end of your rope, but your financial institutions allow you to renegotiate your terms. So it could be lengthening the term of your loan or changing some of the parameters. And that's the part where we're seeing a big rise. Actually, in Canada right now, the amount of proposal is now above the 2019 level in every single provinces in the country.
And you mentioned against that benchmark, we're kind of above where we were before the pandemic. But historically speaking, are we at a point that suggests crisis? Are we in a trend that we have seen before that suggests that's where we're heading?
Well, we're kind of like 2019 was still a decent year. So comparing to that is more, we're back to where we were into what would be a normal year. What's starting to be concerning is the trend. The rise has been much faster than what the normal seasonality would be suggesting. So we're really seeing more and more households coming and having some financial issues. And we have to take into account that insolvencies are very much a lagging indicator of the economic cycle. Usually they tend to peak 12 months after the start of a recession. We still haven't started a recession. So the question is, when are they going to peak and how bad it's going to be before we actually see the peak in insolvencies? If
you're the Bank of Canada, how are you interpreting this data? How does it inform policy?
Well, what it informs is that you're seeing a greater share of households that are struggling with their debt, but you wouldn't be necessarily surprised. Many of that debt was taken at very low interest rates, and now households have to face both a loss in purchasing power because of higher inflation and wage that have not increased or covered all the increase in inflation. And on the flip side, you have higher interest rate on a very high level of indebtedness in the country. So again, squeezing household budget. So it's part of I've called the great consumer squeeze, where households are having a lot of issues finding money to make their financial obligations. So for the Bank of Canada, it's part of, in some ways, some of the collateral damage of fighting inflation. The question is how bad it's going to be, and do we start to see a negative feedback loop into the real economy?
Well, I'm glad you brought up, how bad is it going to be? On Friday, we are going to get another read of the job market in Canada. We are expecting a return to growth, 20,000 jobs added after in May, we lost jobs for the first time in 9 months. How much worse does the insolvency number get, you think, if we start to see job losses pile up, just given the state of household finances right now?
Yeah, well, I think at the moment, a lot of what's helping the market or the Canadian economy is the strength of the labor market, because especially with a high level of indebtedness, most households in this country needs to income to service that debt. So the question is, if we were to have a deeper recession than expected, if we start to see deeper job losses, at some point you may start to see households where the math doesn't work. They don't have the income to support their debt. And in a big part, that's the reason what we've been seeing is more of a rise in proposal while bankruptcies are still quite low, is that banks are and financial institutions are willing to renegotiate the terms of the loans because households still have the income. But when part of that income disappear, then it might transfer where you'll see a rise in bankruptcies. And that's where the negative feedback loop could be a bit more severe on the real economy.
Only 30 seconds left. Middle of July, we get a Bank of Canada rate decision. Consensus does not expect another quarter-point hike. What do you think?
It's a very close call. I think what we've heard from the Bank of Canada at the June meeting is that they're really laser focused on inflation. They really want to kind of prove to the market that they are serious at bringing inflation back to 2%. So it really depends on, we saw the last inflation number wasn't a positive sign. We still have the momentum is still 3.5% to 4%. And even if we remove also mortgage payments, it's closer to target. So there's not necessarily a big need there. The question is, the economy is still quite robust. The labor market is still quite strong. So there's still a lot of excess demand in the system. So that could push them into hiking.
Charles, thanks so much for joining us with that perspective. That's Charles St. Arnaud, Chief Economist with Alberta Central.
Welcome back. We are basically a week away from the next interest rate decision in this country. Of course, Tiff Macklem and the Bank of Canada had stepped off the sidelines not that long ago after pausing on rate hikes at the beginning of the year. Part of that tied to the lingering fight against inflation. We've started to see some improvements on the inflation front, but obviously we've heard time and again that Canada's economy has proven to be resilient. The question with all these interest rate hikes is, where will it leave the economy, especially given the levels of household debt in this country? Earlier, we spoke with Kambiz Kazemi. He's Chief Investment Officer at Validas Risk Management, and he believes further rate hikes could lead to a tipping point for the Canadian economy.
Right now, the market is pricing a 50-50 scenario, is a coin toss. Ultimately, this is a decision of the bank and the government and the committee. So, whatever we think, that's not going to be what matters most. But I want to give some context regarding their decision. Lots of things have changed since the last time that last time we went in, it was a 40-60, 40 to raise, and they actually somewhat surprised the market by raising the rates. Further to that, we had a new CPI number. So this new CPI number, was the lowest we had since June 2021. And even though the bank focused on the core CPI, which remains at 3.9 and is the sticky story that is the worrisome, there's some level of comfort that has come down. The other thing that is very important is unemployment numbers. So again, last time we had an unemployment, which was just a few days after the Bank of Canada made their decision, was the highest unemployment number since August last year. So it's a really difficult balancing game. But the point that you were mentioning about the tipping point that we have discussed and the risk that we have highlighted at Validas a number of times is regarding the leverage of the households. So Canadian households admittedly are very leveraged. Debt to disposable income is about 1.8 times. But more importantly, we have a mortgage situation in Canada, which is very different than other countries. Oftentimes, we tend to compare ourselves, to the U.S. market. But what's very different in Canada is that the duration of our mortgages are shorter. If you will, the Americans have locked in lower for longer, and that's not the case here. And there has been some concern even expressed by, or at least studies done by the Bank of Canada itself about what's called the trigger rate. So when you get to a point where your payment every month doesn't cover your interest payment. So there's, which we can see there. So as the rates go up, three things can happen. Either you get a call from the bank and they tell you you have to raise your monthly payments, or you lengthen your amortization. We have seen that happening by a number of banks up to 35, 40 years instead of the usual 25. Or the other thing that's happened, and three of the Canadian banks offer that, is what's called negative amortization. i.e. you put back the interest you cannot pay in your principal. So none of these things is very good in the long run. And the question is, how do you, measure the impact of those? The Bank of Canada put a paper out. That graph was from there. So if we raise another, in our view, 50 beeps, 0.5% accumulative will be at about 80% of triggers on the variable mortgages. So that's a very high number. And these things usually work themselves out on the longer run, not immediately. So, you can look at 1 quarter or 2 quarter. We're just kind of started. So those are the things that can tip, essentially, not necessarily immediately, but within a quarter or two, the picture as it lags.
And when you say tip us into like a deep recession?
But yeah, so that's a very good point. I mean, it seems that everybody is aiming for a recession anyways to tame the inflation.
Yeah.
The problem we have is that as long as, and that's the measure that we look at it very closely, and I think everybody should pay attention, is unemployment. So the other thing is, as long as essentially you have a job, you'll be able to pay your mortgage, and you just shift a little bit your consumption habits. Maybe you spend less on some things and you make good on the money you owe. But if the unemployment market starts showing more weakness, then essentially, yes, you can have more of a downside and surprise everybody on the abruptness of it.
Yeah, I mean,
So
one of the issues so far is that people have spoken about not just the resilience of the economy, but the robustness of the labor force, and there are a number of factors in there, including immigration, which help to support that. But many people will also note that the jobs picture, and we're going to get some more on that this week, is a lagging indicator. In other words, if we're looking at that future tied to variable rate mortgages, which you spoke to, or even people who are locked into mortgages over the next couple of years and then get that shock coming out of those fixed rate mortgages, we'll see it happens. So is it your message to the Bank of Canada that they should not raise rates next week?
Maybe. I think on the balance, when you look at the CPI having come down,
Yeah.
and even the core CPI, which is the preferred measure now, is below. 3.9 is way below the 4.75 rate, and they have some room for that. In fact, if you look at a very similar situation was Central Bank of Australia. Last night, the market went into a very similar situation. It was a 50-50. And what they did was a kind of a hawkish pause. So essentially, they didn't raise rates, but they sent a very hawkish message, as in, we'll do it if the numbers change. So, that could be a balanced approach for next week's Bank of Canada meeting.
Well, the Canadian government says it will stop advertising on Facebook and Instagram. This comes after Facebook's parent company, Meta, blocked Canadian news on the platforms after Canada's passing of the Online News Act. For more, we are joined by Minister of Heritage, Pablo Rodriguez. Thank you so much for joining us today, Minister.
Thank you, Jackie. Thanks for having me.
So does this feel a bit like you're fighting fire with fire here? Because we have Meta coming out and saying it's blocking Canadian news from its sites because of the Online News Act, and then you're trying to almost one-up them here and taking ads off. Are you feeling a little bit risky in doing this?
Well, what we're saying here is that Meta's attitude is unacceptable. They're trying to intimidate Canadians. And by intimidating Canadians, by the way, they're trying to intimidate Americans and citizens from other countries and also governments from other countries. So what we're saying is, listen, if our government is not standing up to those web giants, who will, right? As of now, in the last years, almost 500 newsrooms closed their door, big and small, in rural communities and cities. Why? Because 80% of all the ad revenues is going to two companies, Meta and Google. And you know what? We're very happy they make money. Good for them. But they have to pay their fair share to the local news, because a free and independent and nonpartisan press is absolutely necessary here in Canada, but also in the States.
Following this news that you're going to be pulling ads, have you heard from Meta?
No, not yet. No, I hope we do. We have, I think, a meeting in a few days with Google. Google is ready to have those conversations. And to be honest, they're tough quite often. We don't always agree, but we're able to sit down and have those conversations. My message to Meta is, come, sit down, let's talk. I'm sure we can find a path forward.
But Google is also not entirely convinced about the concept behind the Online News Act and needing to pay publishers for linking to Canadian news, and has talked about the idea of blocking Canadian news on Google as well. What is different about those conversations that you're having?
That Google is at the table. So we have regular conversations with Google. Met with them, I think, about a week ago. We hope to have another meeting with them in the next few days. Meta, on the other side, has refused to meet with us in the last few days, has blocked the news. And that's a very aggressive attitude, in a way unacceptable also. Imagine if they do the same things in the United States. So you go on the internet, you try to look for news, and whoop, they disappeared. They're not there anymore. So it's unacceptable. There's a way to move forward. There's a path to move forward, and inviting Meta to come at the table and negotiate with us.
They've been pretty, forceful with their language all the way along, though, wouldn't you say, Minister, in terms of talking about the impact, not necessarily being too large to Meta if it didn't have access to Canadian news. Do you think that Meta is going to give in here, or do you think Meta will end up standing its ground as well?
I mean, I wouldn't say it's about giving in or not. I think it's about negotiating. That's the big part of the bill. You know, the bill is very simple. Me, as a minister, I want to be arm's length. I don't want to touch this. The bill essentially is like putting a table in the middle of a room and asking the tech giants, Google, Meta, to sit on one side and newsrooms on the other and agree on deals. And once that's done, then it's over. If not, then they go to file an arbitration, and it gets more complicated. But at the end of the day, it's a commercial approach, and it's a negotiation between the two parties. So Google is asking for more clarity, which is totally normal. I've been in the private sector for a long time also. They need more clarity, more precision on a few things, and I find it totally normal that they ask this. But that is coming now in 2 regulations. I'm pretty sure that Google have like 3 or 4 specific requests. I'm pretty sure that we can meet those requests with the regulations. And I'm telling to Meta, come at the table and let's discuss. Maybe we can get somewhere else also. But to answer your question directly, I think that Meta, by sending this message or by trying to intimidate Canadians, they're also trying to intimidate, as I said, Americans, French, Germans, British, Australians, and people across the world.
What are you willing to negotiate on? And maybe you wouldn't be able to put the cards on the table for us, but could you give us a bit of a sense of, what the conversations could include that, you could still walk away and feel like you've been successful?
Yeah, as you said, we cannot negotiate publicly, but I would say the biggest part of this, the most important, I think, for a company like Google and probably Meta also, is that they want to understand the level of liability, how much they have to invest, how many deals they have to sign, things like that. Those are things that will be clarified during the regulation. So in the next 6 months. And the bill, this is very important, Jacqueline, to mention that doesn't apply to anyone during those 6 months. There's no impact, no consequence until regulations are set, they're ready, and then the bill enters into force. So now there's no consequence. So it's hard to understand why Meta has started blocking news now for some Canadians. I don't know why.
How concerned are you that this isn't going to work out, and that the newsrooms that you're fighting for are going to end up hurt because of this?
Well, I'm optimistic, realistic at the same time. I'm not saying this is easy, but I'm saying that this is possible. But if you take out that bill, we have already lost 500 newsrooms. We're going to keep losing more. And if there's no bill, then there's no reasons for these tech giants to negotiate any value with any of them. From what I've heard in the United States, actually, you have like 2 newspapers closing every week. That's huge, big or small. but they all play a role in big cities or in small communities. By shutting down, this is hurting our democracy, your democracy, which is troubling.
Are you hoping that we heard that the Quebec government has followed your lead here in pulling ads as well. There's a couple of companies that have done so too, involved in the media space. Are you hoping that others, maybe even beyond the media space, would get in on this and try to add to the pressure here on Meta?
I know there's a lot of people looking at what we're doing. I've received many phone calls today from companies, from other levels of government. It's up to them to make the decisions. Maybe they'll be inspired with what we do. But at the same moment, we also know that the world is watching. And I'm having meetings very soon with some American politicians, some from the UK, Australia, Indonesia, Brazil. They're looking at what Canada is doing and see if they can replicate that. And sometimes they have their own bill. They're a bit different, but this problem is the same. So maybe there's a way to exchange and see best practices.
And I understand as you pull money out of advertising for Meta, that money is going to go somewhere media related. What are you planning?
Yeah, it's going to go to other advertising campaigns. We didn't make that decision yet. We just made the decision to pull out from advertising on Facebook and Instagram. We'll see what we do with the money, but it will be reinvested in the news sector.
Okay, advertising directly through news agencies, potentially.
We'll see. We'll have to make this decisions in the next few days.
Okay. Minister, thank you so much for your time today. We really appreciate it.
Thank you very much, Jacqueline.
That was
Bye-bye.
Canada's Minister of Heritage, Pablo Rodriguez.
Welcome back. As investors continue to assess the latest jobs report in the U.S. and boil it down to how the Fed could react next, the next earnings season for big S&P 500 companies is just around the corner. How might they perform in the current economic environment? Let's put that question to John Lynch. He is Chief Investment Officer at Comerica Wealth Management. John, thanks a lot for joining us. First of all, your take on the jobs numbers and the market reaction to those numbers.
Sure. The jobs numbers yesterday, good news was bad news. Today, bad news might be good news because we came in below expectations. And I think the way the market traded yesterday, I think the market was fearing a 6 handle on the Fed funds rate by year end. But now that we came in less than expected on the headline number, I'm surprised. It'll be interesting to see if we hold the lows today from the open. So it'll be interesting to see that because I do think the market will reassess the necessity for the Fed to really step on the gas. But looking a little at more detail, participation rate is held steady. Yet prime working rate is at 83.5% from a participation standpoint. Wages were up. I'm not sure about hours worked, but to the extent hours worked are down, wages are up, the unemployment rate is down. July is definitely still on the table as far as I'm concerned.
Hours worked look to be steady at 34.4 hours.
You.
What about wage growth, though? That number came in at 4.4% annualized wage growth. That was more than, or stronger than economists had forecast, stronger also than the month of May number. And I see the month of May number was actually revised upward by 10 basis points to 4.4%. None of that suggests an easing of inflationary pressures from wages.
Absolutely. Wages, as you know, represent 70% of business costs. So even though we had a lower headline number, this really feeds into the thought process that their underlying wage pressures and underlying inflationary pressures persist. As you know, the CPI number went from 9% to 4% on a year-over-year basis over the past 12 months. However, we're still seeing core PCE prices in that 4.7% range, core CPI prices in the 5.3% range. And if we're seeing wages in that 4.4, I think Fed funds futures predicting 50 basis points before year end. I'm pretty confident in that number.
Okay, let's switch to the upcoming earnings season from big U.S. corporations. What is your broad view of what we may see?
Generally looking at 6 to 7% decline in year-over-year profitability for the S&P 500 index. I think it's really important to emphasize that no one cares what second quarter earnings are going to be. I think more importantly, investors are going to pay attention to what companies say. And what I mean by that is that this is the third consecutive quarter of an earnings decline for the index. And typically, at that point is when you start to see businesses start to reduce expenses, whether it's jobs, whether it's capital investment. And I think that really is going to kind of play into the whole slowing economy fear that investors didn't necessarily embrace over the last 6 or 8 weeks, but may start to re-embrace that thought process. Because if you start getting CapEx reductions, I don't know if the Fed is really attempting to destroy jobs, but I do think the Fed is trying to destroy job openings. And to the degree you start getting some of those requisitions pulled off the table, that also can help serve to slow the economy, but it'll be a negative for the stock price. So I think that 6 or 7% is probably the decline we'll see for the second quarter. But more important is the message on capital investment and job reductions.
We just took a look at price earnings multiples on S&P 500 stocks, both trailing and more importantly, the forward-looking multiple. They have both increased steadily since earlier in this year. What are your thoughts on valuation? After this big rally of 15% plus in the index itself, are these stocks fully valued now or overvalued?
I think they're overvalued given the current economic environment. And when you look at historical data relative to interest rates or relative to inflation, I mean, a 4% CPI typically correlates with a 15.5, maybe a 16 PE. And if we're trading at 19 or 20 right now, that's a little rich. I also think relative to interest rates, the 10-year blew through 385 yesterday. And that broke basically a 10-month downtrend line. So to the degree that interest rates will also factor in to the valuation of equities, I am concerned about that. And if you think about, the leadership that we've had up until the last 3 weeks, it basically been 8 stocks. And my concern there was that investors were still treating long-term profit growth, long-duration equities with a 0% discount rate in hopes that the Fed would end tightening. Yet the short end of the curve, as you know, is 5%, and discounting earnings at 5% as opposed to 0 is a very big difference. So that's another factor that has me concerned about current valuations.
Very quickly, FactSet says that the energy sector in the U.S. is likely to report the biggest pullback in second quarter earnings. That's a pretty big sector of the market up here in Canada, as you know. Any thoughts on the energy stocks, the oil and gas producers?
Yes, the biggest issue, frankly, is oil prices are down 30% on a year-over-year basis, so you can't carry those margins that you had a year ago. So I think it stands to reason that we'll see that decline. Now we just have push-pull between production in North America versus the Saudis trying to decrease production. And I think that's why we've seen, I guess it's a quadruple, if not a quintuple, testing of the lows for WTI and Brent in recent weeks.
John, thanks a great deal for this. John Lynch is Chief Investment Officer at Comerica Wealth Management.